It is Thursday, January 22, 2026. And I have to be honest with you. If you were watching the markets or, the news yesterday, you probably felt that familiar pit in your stomach.
Oh, absolutely. A bit of a nail biter.
We were staring down the barrel of a massive trade war. Bitcoin was diving, and the geopolitical temperature was just freezing.
Right. But fast forward 24 hours.
That crisis is canceled.
Whatever adrenaline you had pumping yesterday, you can probably metabolize it now. It has been a wildly volatile day. We went from the brink of a stagflationary nightmare to what we're now calling the Davos Detente.
The Davos Detente. I like that. It sounds sophisticated, even though the panic leading up to it was anything but. So the headlines are saying the Greenland Tariff crisis is over. Bitcoin bounced back to near $90,000. On the surface, it looks like we're back to business as usual.
On the surface, sure. The price chart looks like a perfect V. We fell, we recovered. But the mission of this deep dive isn't to look at the surface. Because if you look at the flow data, the actual money moving under the hood, there's a massive contradiction staring us right in the face.
I saw some of the numbers this morning, and they just didn't make any sense. The price went up, but the money left.
Exactly. We are calling it the Great Divergence. While the geopolitical tension broke and the asset price saved itself, the retail class, the people buying through ETFs, absolutely capitulated.
Oh, wow.
They panic sold the bottom.
Ouch.
But at the exact same time, the institutional infrastructure players, companies like BitGo and corporate treasuries like Strive, they're doubling down. They're raising hundreds of millions of dollars to buy the infrastructure and the asset itself.
So it's a tale of two investors. One is running for the fire exit, and the other is running in to buy the furniture while the smoke clears.
That is the perfect way to visualize it. So today we need to unpack why that happened, look at the diplomatic maneuvering that saved the market, and then look at a massive technological stress test kicking off today that could redefine speed in this industry.
Okay, let's start with the event that triggered all this, the Davos Detente. We knew U.S. President Trump and NATO Secretary General Mark Rutte were meeting in Switzerland yesterday, Jan 21st. Everyone was expecting fireworks or, at least a stalemate.
Right. Instead, we got a deal.
Or a framework, at least.
You got a framework, which in diplomatic speak means we agree to stop threatening each other while we figure out the details. But the immediate impact was massive. Remember, the U.S. had threatened 10 to 25% tariffs on 8 European nations, the UK, Germany, France, Denmark, set to kick in on February 1st.
Which would have been a disaster. Tariffs usually mean higher prices, slower growth, basically stagflation.
Precisely. That was the tail risk everyone was pricing in. But after the meeting, Trump confirmed he won't impose those tariffs. That threat is off the table.
The economic gun was lowered.
Yeah.
But the U.S. didn't just back down out of the goodness of their hearts. This was about Greenland and the Arctic, right? I kept seeing this phrase Golden Dome popping up.
This is the fascinating part, the security component of the deal. The United States wants to secure the Arctic against, Russian and Chinese influence. They wanted more control over Greenland. So the deal involves integrating Greenland into the U.S. missile defense architecture, the Golden Dome.
Okay, but how does Denmark feel about that? They were pretty adamant about not selling Greenland.
And that's where the diplomatic nuance comes in. Secretary General Rutte specifically stated that ownership wasn't discussed.
Ah, clever wording.
Very. By avoiding the word ownership, Denmark gets to keep its sovereignty, but the U.S. gets its Golden Dome security objectives.
So it's a win-win, or at least a save face.
It allows everyone to declare victory. Denmark keeps the land, the U.S. gets the military access, and most importantly, the markets get to breathe.
Speaking of the markets, let's talk about how Bitcoin behaved before this news broke. Because for all the talk of Bitcoin being digital gold or a hedge against chaos, it didn't look very hedged yesterday morning.
No, it didn't. And this is a really important lesson for listeners. In the immediate heat of a crisis, Bitcoin often acts as a liquidity sponge. When investors get scared, they sell whatever is easiest to sell to raise cash.
So instead of acting like gold, it acted like a high-risk tech stock.
Even worse, it traded in lockstep with the S&P 500. It dropped to a low of around, $87,200. Investors fled to the actual Swiss franc and gold.
Right, the traditional safe havens.
But the moment the news of the détente, the easing of tension hit the wires, we saw a violent V-shaped recovery.
Shooting right back up to test 90,000.
And it validated the thesis that right now, Bitcoin is trading on global trade stability. It's a risk-on asset.
It went up because the world got safer, not because the world got scarier. Okay, so the world is safe, the price is safe. But this brings us to the weirdest part of the story. the paradox. You mentioned a great divergence. If the price recovered, shouldn't the ETF flows be positive?
You would absolutely think so. But the data from the January 21st trading session is, well, it's brutal. We saw a historic capitulation event.
How bad are we talking?
Total net outflows from the U.S. spot Bitcoin ETFs were $708.7 million.
Wait, 700 million in a single day?
In one session.
Yes.
It was the largest outflow in 2 months. And before you ask, no, this wasn't just grayscale bleeding out legacy fees. This was widespread.
So the big boys were selling too, the new funds.
BlackRock's IBIT shed nearly $360 million.
Wow.
Fidelity's FBTC lost almost $290 million. These are the funds that are supposed to be the sticky money, the accumulators of last resort.
That just paints a pretty stark picture. It means the investors in those ETFs, mostly retail, some wealth managers, they got spooked by the tariff headlines and sold right at the bottom.
They bottom-ticked it perfectly. They sold into the liquidity void just hours before the solution was announced. They locked in losses because they just couldn't handle the volatility.
That is painful to even think about. But while they were panic selling, you said other players were doing the exact opposite.
This is why it's a divergence. While the paper allocators were fleeing, the equity market was throwing money at crypto companies. Just look at BitGo Holdings.
They just IPO'd, right? Now, BitGo is a custodian. They hold the keys.
They are the vault, the picks and shovels of the industry. They priced their IPO at $18 a share, which was above their marketed range. They raised over $200 million at a valuation of over $2 billion.
Wait, pause there. The market was dumping Bitcoin, but they were valuing a Bitcoin storage company at $2 billion.
Think about the psychology of that. It's like a gold rush, where everyone is terrified the gold price will crash, but they're still lining up to buy the safes. Investors are saying, I might be scared of the asset's volatility today, but I know for a fact that institutions are going to need custody tomorrow.
They are betting on the infrastructure utility, regardless of the daily price.
Exactly. And BitGo is profitable, $164 million in net income. It's a real business. But then you have the more aggressive play, Strive Enterprises.
This is the firm backed by Vivek Ramaswamy, I saw the headline, raising $150 million via Series A preferred stock.
To buy Bitcoin.
Okay, but I looked at the terms, and I need you to help me understand the math here. The stock pays a 12.25% dividend. That sounds incredibly expensive. Why would you pay 12% interest just to get cash to buy Bitcoin?
It does sound expensive if you think like a traditional CFO, but this is equity arbitrage. Strive's looking at convertible debt markets and saying, we can borrow this money at 12%. If they believe Bitcoin will appreciate more than 12% in a year, that money is effectively free, or better, it's profit.
So they're just levering up. They're betting the asset outperforms the loan.
It's the corporate treasury standard playbook. They are using financial engineering to retire old debt and load up on the asset. While the ETF investors are scared of a 5% drop, Strive is paying 12% a year just for the privilege of holding more coins.
That's the difference in conviction.
That is the difference in conviction levels right now.
The weak hands transferred their opportunity to the strong hands. It's a tale as old as markets.
And it sets the stage for what comes next. Because while all this money is moving around, the technology underlying all of it is being tested to its breaking point.
Right. We have a good news, bad news situation in the tech stack today. Let's rip the Band-Aid off and start with the bad news, the Saga protocol exploit.
Yeah, this was a mess. Saga is a layer 1 blockchain. On January 21st, their bridge, the Saga EVM bridge, was drained of $7 million.
Bridges are always the weak link, aren't they? Was this a private key leak? Did someone steal a password?
No, this was a smart contract failure. It's a bit technical, but think of a blockchain bridge like a border crossing. Usually you hand over $1 on side A, the guard locks it in a vault, and gives you a receipt, a token to use on side B.
Simple enough.
Well, the attacker here didn't steal the money from the vault. They tricked the code into writing millions of receipts on side B without ever putting money in the vault on side A.
They manipulated the payload.
Yes. They basically printed fake money on the sidechain and then exchanged it for real money.
So they minted Saga dollar out of thin air and bridged it out for real USDC and ETH.
Exactly. The Saga dollar depegged to 75 cents almost immediately. Total value locked, crashed 55%.
It's just a stark reminder that interoperability is still incredibly risky. But on the flip side, we have someone trying to prove that the tech can handle the pressure. Mega ETH.
This is the story to watch today. Mega ETH initiated its mainnet launch sequence this morning, and they are not tiptoeing in. They are launching with what they call a global stress test.
I saw the target number and I honestly thought it was a typo. 11 billion transactions.
In 7 days. To give you some context, that is orders of magnitude higher than anything we see on Ethereum today. Their internal tests hit 47,000 transactions per second.
47,000. Ethereum does what, maybe 30?
On the base layer, yes. Even Solana claims a few thousand effectively. Mega ETH is trying to prove that an EVM-compatible chain one that speaks Ethereum's language can run at the speed of a high-frequency trading firm.
Or a massive consumer app.
Right. And that's why the speed matters to the average person. If you want to run a game or a social network or a real-time exchange on a blockchain, you can't wait seconds for a confirmation. You need milliseconds.
So they're actually putting it to the test with real apps.
They're running a game called Stonk.gg live on the chain to prove it works. If they succeed, it really changes the narrative about what blockchains can actually be used for.
High stakes. If they pull it off, it's a breakthrough. If the network crashes, well, it's just another fast chain that broke.
High risk, high reward. And speaking of risk, I have to mention one other piece of news from the tech layer. River Protocol.
Oh, the project that just got investment from Justin Sun and Tron.
Yes, an $8 million investment. The token price pumped to an all-time high of $48. But listeners need to be very, very careful here.
Why is that? Investment is usually good.
Look at the volume. The futures volume, so people betting on the price, is 80 times higher than the spot volume people actually buying the token.
80 times. That sounds artificial.
It suggests engineered price action. It looks like a short squeeze setup rather than organic growth. When you see leverage that high compared to real buying, it's usually a trap for retail traders.
Good warning. If it looks too good to be true, check the leverage. Okay, let's zoom out. We've covered the macro, the money, and the tech. But what about the rules of the road? We have news out of Washington and Vietnam.
Washington first. Senator John Boozman, the Senate Ag Chair, finally released the text for the digital commodities bill.
Finally. We've been waiting for clarity on what's a commodity and what's a security for years. Is this the breakthrough?
Unfortunately, probably not. Boozman admitted he couldn't reach a deal with the Democrats, specifically Cory Booker. He's forcing a markup for January 27th, but without bipartisan support, this thing is likely dead on arrival for Q1.
So more gridlock. Fantastic.
However, while Congress is stuck, the private sector is filing for something that could be a holy grail for market structure. FM Investments filed with the SEC to tokenize shares of a U.S. Treasury ETF.
Now, hang on. We've seen tokenized treasuries. We've seen wrapped tokens. Why is this filing different? Why do you call it a holy grail?
Because those other examples are usually wrapped versions or derivatives. This filing is for the actual ETF shares to be recorded on a blockchain. They keep their CU-SIP number. They keep their protections under the 1940 Act.
Okay, so it's a real regulated security just living on a ledger instead of in a database.
Right. And here's why that matters. Settlement time. Right now, if you sell a treasury bill on a Friday, you might not get the cash until Tuesday. It's T+1 or worse.
Money sleeps over the weekend.
Exactly. But if the share lives on a blockchain, settlement can be atomic, instant, 24/7. It eliminates the counterparty risk and the waiting period. If this gets approved, it bridges the gap between TradFi safety and DeFi speed. It effectively makes T+1 obsolete.
That would be a massive unlock for liquidity. But while the U.S. is trying to speed things up, Vietnam seems to be putting up walls.
A capital wall. Vietnam launched a pilot exchange licensing regime. But the barrier to entry is just staggering.
What's the price of admission?
Minimum capital of 10 trillion Vietnamese dong. That's about 400 million US dollars.
400 million? That's not a regulation. That's a keep-out sign.
It's a moat. It locks out every startup, every innovator. It reserves the Vietnamese market exclusively for massive global institutions or massive local banks.
It seems like a trend, doesn't it? Whether it's complicated SEC filings or half-billion-dollar capital requirements, the game is being rigged for the incumbents.
The industry is maturing, and unfortunately, maturity often looks like consolidation.
So let's try to pull all these threads together. We started with a geopolitical crisis that vanished, leading to a market recovery that retail investors missed, while institutions loaded up on infrastructure.
And we're seeing tech that is either breaking, like Saga, or trying to break the sound barrier with Mega ETH. It's a chaotic landscape.
If you had to boil this all down for our listener, what is the one big takeaway from today?
I keep coming back to that divergence. We often talk about Bitcoin has public money, a network for the people. But just look at what happened in the last 24 hours.
The people sold.
The new whales, the ETF investors, panicked at the first sign of trouble. They let the geopolitical headlines shake them out of their positions.
And the infrastructure whales, BitGo, Strive, use that fear to build deeper moats.
Exactly. So here's the provocative thought I'll leave you with. Are we witnessing a transfer of the network's soul? If the public sells every time there's a scare, and the corporations accumulate every time there's a dip, are we moving from a people's currency to a corporate utility?
That is a heavy concept, a transfer of the network's soul from the individual to the institution.
It is happening right in front of us in the flow data. And if you want to know if that trend holds, just watch the next 48 hours.
What are we looking for?
Watch the ETF flows tomorrow. Now that the Davos Detente is confirmed, do the retail investors come back? Do we see inflows? If IBIT continues to bleed, it means confidence is broken, and 86,000 is the next downside target.
And on the tech side?
Keep your eyes on that mega ETH transaction counter. If they hit 11 billion without halting the chain, the narrative around what's possible on Ethereum changes overnight.
It feels like we are at a pivot point. The politics, the money, and the tech are all shifting gears at the same time.
It's never boring.
It certainly isn't. We'll be right here watching those flows and that transaction counter so you don't have to. Thanks for diving in with us today.